You spent 40 years saving for retirement. You paid your dues. You thought the taxes stopped when the paycheck stopped. You were wrong. In 2026, a silent tax torpedo is aiming for your wallet. From the Social Security tax trap to the devastating widow's penalty, the government has hidden ways to claw back your hard-earned money. I'm the Wise Senior, and today I'm showing you the 30 tax secrets that could save you thousands this year. Let's defuse this bomb. Fact number 1. The Provisional Income Formula. This is the math the IRS uses to tax your Social Security. If your combined income, that's your adjusted gross income plus half your benefits, is over $25,000 for singles or $32,000 for couples, you pay taxes on up to 50% of your benefits. Fact number 2. The 85% cliff. It gets worse. If you earn just a little more, over $34,000 as a single filer or $44,000 as a couple, up to 85% of your Social Security becomes taxable income. That is a massive jump. Fact number 3. The fiscal drag. These threshold numbers were set in 1984 and never adjusted for inflation. Back then, $25,000 was a lot of money. Today, it's near the poverty line, yet the tax remains. Fact number 4. State taxes. Even if you dodge the IRS, your state might catch you. 9 states still tax Social Security benefits. If you live in places like Connecticut or Vermont, check your local laws immediately. Fact number 5. The tax torpedo. This is a hidden marginal tax rate. Because earning $1 extra from an IRA triggers taxes on 85 cents of Social Security, your effective tax rate can spike to over 40%, even if you aren't rich. Fact number 6. Required minimum distributions, or RMDs. Starting at age 73, the government forces you to withdraw money from your pre-tax accounts, whether you need it or not, pushing your taxable income higher. Fact number 7. The penalty. If you miss an RMD deadline, the penalty is 25% of the amount you didn't withdraw. It used to be 50%, but losing a quarter of your money is still a tragedy. Fact number 8. The aggregation rule. You can combine RMDs for all your IRAs and take it from just one account. However, you cannot do this with 401s. Each 401k must be drained separately. Fact number 9. Roth conversions. This is your defense. You can choose to pay taxes now to convert your IRA to a Roth IRA. Roth withdrawals are tax-free forever and have 0 RMDs. Fact number 10. The backdoor Roth. If your income is too high to contribute to a Roth directly, there is a legal loophole that allows you to move money into a Roth anyway. Use it. Fact number 11. Phantom income. Be careful with taxable investment accounts. Reinvested dividends count as taxable income every single year, even if you never touched the cash. Fact number 12. The widow's penalty. This is the most heartbreaking trap. When a spouse passes away, the survivor must file as single the following year. Your tax brackets shrink significantly. Fact number 13. The Standard Deduction drop. A surviving spouse loses half of the Standard Deduction, meaning more of their income is exposed to taxes immediately. Fact number 14. The 10-year rule. If you leave a traditional IRA to your children, they must empty the entire account within 10 years. This forces them to pay huge taxes during their peak earning years. Fact number 15. Step up in basis. Never gift your house to your kids while you are alive. If they inherit it after you pass, the tax basis resets to the current value, and they can sell it tax-free. Fact number 16. The kiddie tax. If you try to shift investment income to a grandchild to save money, the IRS will tax their unearned income at the parent's much higher rate. Fact number 17. The municipal bond trap. You are told muni bonds are tax-free. They are free from federal tax, but the interest is added back to your Provisional Income Formula, which can trigger taxes on your Social Security. Fact number 18. The capital gains bump. Long-term capital gains tax is usually 15%, but if your income rises, it bumps up to 20%. And this stacks on top of your ordinary income. Fact number 19. The 0% bracket. This is a secret sweet spot. If your taxable income is low, under roughly $47,000 for singles, you pay 0% tax on stock sales. This is the best time to sell your winners. Fact number 20. Capital loss harvesting. Sold a loser? You can use those losses to offset your gains, plus deduct up to $3,000 against your ordinary income every year. Fact number 21. Annuity taxation. Be careful. Earnings from annuities usually come out first, last in, first out, and are taxed as ordinary income, not the lower capital gains rate. Fact number 22. The NIIT surcharge. The net investment income tax adds an extra 3.8% tax to your investment income if your AGI goes over $200,000. Fact number 23. The wash sale rule. You cannot sell a stock for a loss and buy it back within 30 days. If you do, the IRS will disallow your tax deduction. Fact number 24. State estate taxes. The federal exemption is high, but states like Massachusetts or Oregon tax estates as low as $1 million. Your house alone could trigger this tax. Fact number 25. Property tax freeze. Many states offer seniors a freeze on property taxes once they hit age 65, but you have to apply for it. They won't tell you automatically. Fact number 26. Sale of home exclusion. You can exclude $250,000 of profit from taxes when selling your home, or $500,000 for couples, but you must have lived there for 2 of the last 5 years. Fact number 27. The domicile audit. Moving to a tax-free state like Florida? If you keep your old doctor or bank in New York can claim you never left and tax you anyway. Fact number 28. The TCJA expiration. On January 1, 2026, the current low-income tax rates are set to expire. The 12% bracket will likely jump to 15% and the 22% bracket to 25%. Fact number 29. The Standard Deduction halves. In 2026, the Standard Deduction could be cut nearly in half. This will force millions of seniors to go back to the complex nightmare of itemizing deductions. Fact number 30. QCDS, or Qualified Charitable Distributions. This is the ultimate loophole. If you are 70 and a half, you can donate from your IRA directly to charity. It satisfies your RMD requirement, but counts as 0 taxable income. Use this to lower your bracket before the 2026 tax hikes. 30 facts. 1 goal: keeping your money yours. The 2026 tax hike is coming, but now you have the blueprint to survive it. Which of these taxes shocked you the most? The widow's penalty or the municipal bond trap? Tell me in the comments below. And if you missed my warning about hidden Medicare penalties, click this video immediately. Don't let the government win twice. Stay wise, pay less. I'll see you in the next one.